Episode 9, Cities on the Rise. What's next for the housing market and investors? Welcome back to episode 9 of the Groundfloor Market Trends podcast. I'm your host, Patrick Donoghue, Vice President of Market Risk at Groundfloor. Well, the election is over. And I think taking a deep breath is good and warranted. That election really ratcheted up in ways unseen in recent memory. I definitely feared civil unrest, no matter what the result was, but thankfully, it seems we will have a peaceful transition of power. Whether or not the result was what you wanted, and maybe it wasn't, the tide is moving forward. And what's important for me is to describe the trends and hopefully help you steer profitably in the housing market ahead. We certainly do have our challenges, like high interest rates and affordability. But when you look under the hood, the market is showing some surprising areas of strength. We're here to break that down and what it means for you as an investor. So with all of that said, let's jump into it. The return of cities. Let's start talking about something surprising, the return to city living. For a while, around the pandemic time, cities seemed to be on the decline, with people leaving for suburbs and rural areas. But according to the National Association of Realtors, in their latest buyer profile, urban areas are back in demand. In fact, city home purchases now make up 16% of the market, higher than they were before the pandemic. The suburbs are still leading with 45%, but the COVID-driven shift to rural living has mostly reversed. And that's according to Housing Wire, November 5th, 2024. So what's bringing people back to cities? A big factor is the return to office trend. As more companies bring employees back in, people are rethinking those long commutes, God knows I have one, and looking to move closer to urban centers. But here's an interesting twist. People aren't moving as far as they did during the pandemic. The typical moving distance has dropped from 50 miles in 2022 to just 20 miles now. It seems people are finding a balance, close enough to enjoy city amenities and shorter commutes, but still with enough space to keep some of the lifestyle changes they picked up during the pandemic. Well, what's going on with home prices? The latest quarter-over-quarter data from NAR is the National Association of Realtors, and I'm going to use NAR because it's quite cumbersome to say National Association of Realtors every time. It shows that the prices are still rising in 87% of major metro areas, but the pace of growth, the rate of change, is slowing down. Only 7% of metros saw double-digit growth in Q3, down from 13% in Q2. It feels like the market is catching its breath after an intense couple of years. And that's Housing Wire, November 7th, 2024. Regionally, we're seeing some interesting dynamics. The Northeast is leading with a 7.8% price increase, followed by the Midwest at 4.3%. The Midwest is Groundfloor's second leading market, and the West is cooling with just a 1.8% increase. And the South, which is Groundfloor's leading market, is showing a modest 0.8% rise. And get this, 4 cities in Illinois made it into the top 10 for price growth, showing that you don't have to be on the coast to find great investment opportunities. So let's all note that as investors. You don't have to be on the coast to find great investment opportunities. Interest rates. Let's call interest rates the market's mood maker. Now, we can't ignore interest rates. They're setting the tone for today's market, like they set the tone for most markets. And mortgage rates around 6.93% as of early November. It's a very big jump from the pandemic lows of 2-3%. But buyers and sellers seem to be adjusting. Housing Wire's Logan Madashomi noted that when rates were between 6.75% and 7.5%, many buyers held back. But as rates started moving closer to 6, more people jumped back in. Home purchase applications over the near-term range during that time showed 12 weekly positive reports compared to only 5 negative ones. And that's from the November 2nd, 2024 Housing Wire report. We also saw a recent rate cut from the Fed of 0.25%. Geez, what a week. We had a Fed rate cut and a new president elected. While the Fed doesn't set mortgage rates, it definitely has influence. Central influence, that's a bad joke. Any downward pressure can help bring more buyers back into the market. And speaking of influences, the 10-year Treasury yield recently jumped a bit, likely due to investors making moves based on expected post-election policies. Inflationary concerns from both candidates' policies flaming the yield increases. And unfortunately, these higher Treasury yields could keep mortgage rates elevated. Buyers, like first-time home buyers, hoping for more affordable options, may need to adjust the realities of the high to mid-6 mortgage rates for a while. Supply and construction, a very complex picture. We're going to shift gears to housing supply because it's always a critical part of the market equation. Right now, we have about 735,718 homes for sale in the United States, with around 60,000 new listings entering the market each week. While that sounds like a lot, it's actually quite modest in comparison. Like during the 2009-2011 period, where we saw over 280,000 new listings per week. You could think of that as down 75% from the period now compared to the period of 2009 to 2011. And when it comes to new construction, there's been an interesting trend. Homes are getting bigger. According to a report from Stringer, SQ, and Keller, the typical new home has grown from 1,900 square feet in 1990 to 2,400 square feet today. It's like adding an extra whole master suite. This increase in size raises construction costs, which impacts affordability, especially for first-time home buyers. And on top of that, materials unexpectedly aren't getting any cheaper. I have to be accountable to my call for materials decreasing in cost this year. But we're seeing, according to Sarah Wallach from Housing Wire, reported that framing lumber prices went up 2.9% for the week ending November 1st and are 17.2% higher than they were last year. And that's on the November 8th, 2024 Housing Wire report. These fluctuations in material costs make it harder to keep construction and renovation projects affordable, adding yet another challenge to this market. So what does it all mean for investors? The good news is that there are still opportunities out there. We're seeing very few distressed properties and almost no defaults in the owner-occupied mortgage space, which shows that market foundation is solid, even with a higher rate environment. The return of buyers to cities could open up possibilities in urban areas where prices may have dropped during the pandemic. We're also seeing significant regional variation. Midwest markets, as I noted, are performing strongly, while traditionally hot coastal markets are cooling down a bit. You can think of this as the search for value. This kind of variation creates unique opportunities for investors who are willing to dig into the data and adapt to the local trends. As we look towards 2025, we are keeping an eye on several factors that could shape the market. The recent Fed cut could signal a trend toward making mortgages a bit more affordable. And we're watching how urban living continues to evolve as companies set the long-term work policies. For ground floor investors, our approach remains focused on diversification and local market awareness. I'm particularly excited about their Flywheel portfolio, which combines 200 to 400 short-term real estate loans into one portfolio to offer monthly cash flow and instant diversification. Projected returns in the 10 to 11% range, inclusive of fees, which is especially attractive given today's market challenges. With 95% of these loans expected to repay within 24 months, the Flywheel portfolio is designed to deliver consistent returns and offers monthly disbursements that you can reinvest for growth. It's an easy way to gain exposure across regions and property types with a minimum investment of just $100, letting you spread the risk while maintaining positive yields. We'll continue tracking these trends closely as we move into the new year. The market has its challenges for sure, but it's also offering opportunities for investors who stay informed and take a disciplined approach. So thanks for joining us today on episode 9, Cities on the Rise, What's Next for the Housing Market and Investors, here on the Ground Floor Market Trends podcast. I hope you found today's insights helpful. We'll be back with more updates, so stay tuned and don't forget to subscribe. And we'll see you next time. Happy investing.